pardon the way I look. I just had to rush and do this. So this is going to be a question and answer session. The frequently asked questions that I get every single day on Instagram, TikTok, Twitter. People just asking about finances and how they can start investing and budgeting. So the very first question that I have here is, how can I create a budget that actually works? So for me, the answer to this question is there is no one size fits all, and you have to give yourself grace. So what I mean by this is people can tell you, oh, you have to save 20% of your income or 30% of your income based on the rule. And I'm like, for you, it depends on your earning power. How feasible is it for you to save 20% of your income? We all know that the cost of living crisis is high. So how feasible actually is it for you to save 20% of your income? Which is why I always like to shout it through the rooftop that investing is something you can start small, and then over time you can basically build up your portfolio. So when it comes to budgeting, there's literally not one size fits all. So you do not have to listen to what everybody say. Budget according to your needs. So for example, you can say, okay, based off of what you earn, you budget what are you comfortable investing, what are you comfortable saving. So for me, I like to do the value-based budgeting. So basically what this means is I every month I decide what is so important to me that I get to spend money on. So for example, in the month of March, I can say, okay, I want to upskill, I want to get new skills, I want to have a promotion at work, I want to increase my income. So that means that for the month of March, a certain percentage of my money or most of my savings will go towards buying courses, paying for coaching sessions, basically to upskill and get the knowledge. Then in the month of April, I can say, okay, I've upskilled in March. This is April. I want to get my investment account from a certain amount to a certain amount. And basically, I'll focus on investing that month. And in another month I can say, okay, I want to focus on traveling, I want to focus on doing something nice for myself, and that is exactly what I'm going to focus on. So what I'm trying to say is you can budget based off your income level. You basically do not need to like do what everybody's doing, so the generic rule of budgeting is just general, but it doesn't have to apply to you. You have to figure out what works for you and then tweak and adjust as you go. And one important thing I always say is whilst you're budgeting, try to increase your earning power. Second question says, how much should I save for an emergency fund? So basically, an emergency fund has to be 3 to 6 months off your living expense. It could be more, it could be less, but basically it has to be something that catches you when you fall. So whenever you have an emergency, it has to be something that is tangible enough to save you from that emergency. For me, how I do my emergency fund, I'm going to be using myself as a case study for most of these questions, is I try to budget at least 3 to 6 months of my emergency fund, put it in a high yield savings account or a mutual fund, a place where my money compounds really fast, and oftentimes, to the glory of God, when there is no emergency, I tend to use the bulk money I've saved from emergency fund to invest somewhere, or I take part of it, or I take the full on amount. So emergency could be anything. What qualifies as an emergency for you? It could be you need to get a new phone to start like an online creation business or an online and content business. You need to get a new laptop to take a course, or you need to get a car to make your life easier, or you need to go on a vacation to distress and clear your head. So every single thing can be an emergency, but it based off of you as an individual. And Michael said, I suppose lower, less income, of course, means less risky investment. Not really. Michael, not at all. So let me touch on that question before I forget. So your question is lower, less income means less risky investments. No. So when it comes to your risk profile, so there's the high risk, the medium risk, and the low risk, right? You can be all three of them. You can be a low to medium to high risk investor, or you can be just a medium risk investor or a low risk investor. It all boils down to how you're willing to allocate your funds to those investments. For example, I can be a medium risk investor or a medium to high risk investor. And I'll say, okay, what that means is if I have £10,000 to invest, I'll probably invest £6,000 in a medium risk investment like a high yield savings account, a mutual fund, a money market fund, an index fund. And then the remaining 40%, I can choose to just put it in a higher risk investment or split it between a high and a low risk investment. But basically, I am still a medium risk investor because I appropriated 60% of my funds to a medium risk investment. Now, when it comes to risk versus reward, we generally know that the higher the risk, the higher the reward. But not every high risk investment means that you will lose money. This is where you need to understand what you call the returns mean. So there's unrealized profit, there's unrealized losses. So this is where you have to understand. So for example, a stock investment, you can say, okay, our stocks are risky. You know, if you put your money, you're going to lose money. Stocks are volatile and they are risky, yes. But the fact that you put, let's say, £500 in the stock market today, and tomorrow, currently, the market is red, the market is bearish, and you open your profile and you see that, oh, you have £200, you start panicking. You do not have to panic. You have to have emotional control as an investor. So the fact that you have £200 sitting there doesn't necessarily mean it's a loss. It is a temporary loss, like it's a loss for that moment, but it's not a final loss. It only becomes final if you panic and sell. Then that way you do not have any means of recovering your money back. But if you leave that money there, that £200 or £300 has capacity to go back to your initial capital, which is 500, and even exceed it. So basically, the fact that you have less income does not mean that you have to take less risky investment. Like I said, instead look for ways to upskill, because like we all know, the higher the risk, the higher the reward. But then there are medium risk investments that also give really high rewards. So I hope that answers your question. Income has nothing to do with risk. It's about you as an individual and your strategy. That is the most important thing. That's why you basically need to like be guided and have guidance. The third question is, how can I improve my credit score? This is quite tricky because I know some people that literally have not done anything. They do not have a credit card and they have really good credit score, while there are people that literally keep paying money every time. So I think for credit, just basically, I know what I've seen, what I've known, what worked for me is register in your electoral. Like if you want to vote, make sure you're registered. When you take out credits, make sure to pay back, every month, or at least pay back the minimum balance. If you take out bulk credit, I heard that if you try to pay it back in full, that will reduce your credit score because, well, we all know how the debt society thrives. So what I would say is just take out loans and debts that you can afford to pay back. So I use credit for like the very, very mundane things that I know that literally at the end of the month, it will be easier for me to pay back. So that is what you should aim to use your credit for. I think the key factor is pay back regularly as at when due. So only take what you're willing to spend, basically, or what you can pay back. Um, what percentage of my income should I invest? I would say 10 to 20%, but again, it depends on you. The goal about building wealth is the fact that no amount of money is too small to invest. Your money can compound. So compound interest is the eighth wonder of the world. So with compound interest, your money can go from 0 to 100. And most importantly, if you're invested, for example, in instruments like the stock market, that is where your £100, your $100 can easily go to 1K in a day, in 2 days, in 1 month, in 2 months. So that is why I would not say because you think you do not have up to 10%, or because the money you have is less, therefore you shouldn't invest. No, if you can afford to invest $10, £1, £10, £20, by all means, please do. It doesn't have to be 15 to 20%, but that's just like the general rule. But what I always say is, if you have extra disposable income, always put it towards your investment. Don't say because you have extra income, you now remember like an expense that literally you have been surviving without, and then you now go and buy it. No. So if you have extra income, try to save, try to invest. You're paying your future self, and over time, you find out that you're going to be good to go. Exit strategy. What type of strategies can you take when trying to withdraw all positions? A six-figure portfolio in stock. So for exit strategy, so that would depend. I need to know what's your age. basically. Because for me, I always like to say that stock investing is not the only investment option available for you. So for me to actually know what to say about exit strategy, I need to know your age. You know, why do you want to pull out of the investment? Obviously, it could be to move it to a more safer investment portfolio. Are you investing in a tax wrapper, or are you investing without a tax wrapper? So these are the kind of questions that basically I would need to know and analyze if I can say what strategies can you take to withdraw all positions. But let's say you put a six-figure portfolio in stocks. That will basically mean that you have to sell off, so you need to first know your average, and so you can strategically, sell for profit. But I assume that if you've built a six-figure, you've been compounding your investments over time. That way, I do not really think that there's really going to be any losses. What you should really be bothered about would be the tax implications of your profit. So tax implications of your dividends, tax implications of your capital gains. What are your taxes? Like, what's your tax rate? How much are you going to be taxed if you take out, that investment? Now, of course, you cannot take it out at once unless you're like a proper millionaire, like all the insider traders you read about online. It's probably be like depending on the market season, you can take it out bit by bit. But like I said, there are several other factors to consider before I can answer that fully. Yes. Okay. So the next question is, what's the best way to start investing as a beginner? So as a beginner investor, here are the things you have to keep in mind. First, what is your goal? I always say this because your goal is very important. It helps you to drown the noise if you know why you're investing. Some people will say you should have multiple investment goals, multiple investment funds, or sinking funds for various reasons. But I personally do not advise that, because I find out that human needs are insatiable, and if you have multiple investment goals, long, mid, short term, usually, oftentimes, the longer term goals suffer because we are so focused on the shorter term and the medium term goals. So you're so focused on the goals that you're literally ignoring your longer term goals because you think you have time, and at the end of the day, you realize that you really do not have as much time as you thought. So you need to know why you're investing, what are you investing for, then just every other thing can fall under that. So for example, I can say, okay, I'm investing because I want to retire early. So every investment I'm doing, or every investment I want to do, has to fall under retiring early. So how can this investment aid my retirement journey, aid my financial goal to want to retire early? That's basically what I always say. So when you know your goal, it's easier. And number two, understand your risk profile. What type of risk are you willing to take? Based on your level, your income level. Are you married? Are you single? How comfortable are you with losing money? Like I said, like when you see your money down by a certain percentage, do you really panic and sell? Or are you able to just like drown the noise, close your app, buy more if possible, and then go to sleep? So these are things you need to ask yourself. Then after you've known your risk profile and your goal, it now helps you to itemize the investment options that are available to you based on this information that we've gathered. So if your risk profile is, for example, you're a low risk investor or you're a medium risk investor, you cannot itemize. So example of low risk investments, we have bonds, treasury bills, fixed income, like your fixed deposit, your cash ISAs. Then for medium risk, we have the ETFs, index funds, mutual funds, money market funds. And the high risk, we have crypto, stocks, and then we have alternate investments like art and stuff like that. So when you now know your risk profile, you can now pick and choose from this range of investments what you want and what suits you. And the amazing part is, with compound interest, you're going to be able to predict, how much you want to make or how much you want to have invested in a certain period of time. So you could say, for example, I want to have 100K investment in 10 years, right? So using compound interest formula and the future value of money, you can now say, okay, 100K investment in 10 years, that means that you have to invest XYZ amounts. It could be £1,000 every month at an interest rate of 10%, every single month, for you to be able to hit 100K in investment in 10 years. So it's very simple. When you know your risk profile and then you know the investment options available to you, you open a brokerage account. This is another important part. And brokerage account is not just by the popular one, the flashy one. Open a brokerage account and watch out for fees. That's number one. How good is their customer service? Try it out before you start putting money there. That's number two. Fees, because fees can really eat into your return on investment. So a 2% fee on my investment might mean nothing to me, because of the size of capital I have invested. But a 2% fee on investment of, let's say, Sandra will mean a lot to her because of the size of capital that she has invested. So these are the things you want to watch out for: the fees, the customer service, because I mean, you want to always have access to customer service to ask for, ask questions if anything is wrong, or if an app is down, or if there's something wrong with your portfolio. So these are the things to watch out for. So when you open like a brokerage account, watch out for fees, customer service, then you can now start investing. So that is very simple as that. Fund your account, start investing. Now you can do fractional investments. You don't need to have lots of money. You can start with £10, £100, £5, etc., etc. So yeah, okay, this is not investing. This is what are the best passive income ideas? To be fair, I'm still figuring it out, because everything that is passive has required some sort of work. And just in case anybody knows any easy, emphasis on the word easy, passive income ideas, please send it my way. But what I do that gives me passive income, some of the things I've done. Well, first on the list is investing, which I cannot keep talking about. Like, we all know that. So this month alone, I've earned $783 from my investment account. My investments paid me $783. So the money, however, is going to be reinvested, yes. But I mean, seeing that money gives me joy. If, for example, I had need of spending the money, I would have spent it. But because I did not have any need to spend the money, I didn't spend it, right? So it's gonna be reinvested. So which means that my capital is gonna be increased by $783, and the next payout is probably gonna be slightly higher because I am compounding my money. So that's the one way, that I am passive income. Of course, like, it took a lot of time. So investing is a long-term game. I've been investing for the past 14 years consistently, every single month. In fact, right now I do it daily or weekly. I have not stopped. I usually like spoil myself by taking out money from my passive income. But whenever I want to spoil myself, I rather take out money from passive and always add my salary to capital and take out money from capital, or not, rather than not investing at all. So obviously I've gotten to a point where my passive income is sizable and tangible, and it can take me on vacations. I can use it to buy a luxury bag, or I can decide to, quit work and take a 1 year gap or a 6 months gap, or as the case might be. So that is something you can do as well. You just have to start. Then second thing I do that gives me passive income, but currently is digital products. So selling digital products is just there. I run ads sometimes, but I haven't run ads. I have not run ads in a couple of weeks or months rather. So people, I just use my Instagram to market, once in a while, talk about it, and people buy, or people come and ask me, well, do you have digital products and all that? Then so coaching is not actually passive. I say passive because people just go to the website and book a session or a slot. I do not actually have to like say okay anything, unless when I'm talking about it together with like the digital products. Another thing I'm hoping that's gonna give me passive income has got to be YouTube, right? I mean, so hopefully in the nearest future, YouTube gives me passive income. But well, systems are still being set in place and all. But what else? What else do I do that gives me passive income? Let's see. So to be fair, like, the biggest passive income I earn right now is from investments. I used to have a business, but that has shut down right now. I'm currently starting another one where I'm trying to use the affiliate on TikTok. So hopefully I'm able to do that and get the affiliate. It will be semi passive, because basically people will just, I have to fulfill the order, although people can just buy from there. Something else I've tried in the past, but I couldn't sustain it, was Printify, print on demand. I can post the link later in the comment section after this session, or the description. Printify. So basically, I just had to sign up, pay the subscription fee, create designs on Canva. The company fulfills the order, creates the product, and sell. So I just get paid for it. But when it comes to actually design the design, I have to do it myself. So you see, it's not so passive. I don't think there's anything that is really fully passive, to be honest. You must have done some sort of work at some point, before it becomes passive. General, in terms of setting a price target for selling a stock, let's say in some instances the price has reached the price target years ahead in advance. Okay, so when it comes to price target, Michael, I think it's basically how comfortable you are with the profits you've made, So setting a price target, you actually have to be able to time the market and do some technical analysis. That's the only way you can set a good price target or exit. For example, let's say you buy PLTR. So when we bought PLTR in my investment group, when we bought PLTR, like 20, 25, 30. Currently, it went to 120. Currently, it's at 88. So it might look like a loss for most people, but for us, we are still in some kind of profit. I know people that sold at 120, so 120 was good enough for them. So I think basically you have to be able to like do some analysis and time the market and decide what profit is enough for you, because your 500% profit might not be enough for someone else, but it might be enough for you. So just learn technical analysis, basically, like what is the resistance points, like what is, like, where has the stock, where does this drop to? There's usually like a limit a stock drops to, and the resistance points where it finds it very difficult to go above or something. But then we know that with technological advancements every single day, every single year, like one new is AI currently. We are looking at cloud computing. Next year, in 2 years, we don't know what is going to be that will take the stocks from a 0 to 100 again, or from 100 to 1,000. So that's the thing. So what I'd always say is take profit. I'm always of the opinion of taking profit. Like, every investment, take profit. Because remember what I said earlier, unrealized profit and loss. The profit is yours, quite all right. Your portfolio is compounding, you're making money. But unless the money is sitting in your bank account, so take profit. So what I always say is, if you take profit, then you can put it in other lesser investment instrument, like mutual funds, high yield savings accounts, and fixed income instruments that you're sure, you're guaranteed that your capital is safe, and you get a certain amount, every month, or every quarter, or every day. That's the investment that compounds. Okay, the next question is, should I focus on paying off debt or saving for retirement? So they are both important, but like I always say, there's something called the time value of money and the future value of money. So what I would say is, look for a balance between paying off debt and saving for retirement. Retirement is your future, and when you save that money, you earn interest, it compounds, So I always say, like, if you have, for example, 50,000 pounds debt or whatever, and you want to pay it off, you have the cash. Only do that if, like, you go and meet the lender and they say, oh, okay, because you're giving us all the money, we're going to give you a discount of, let's say, sizable, a significant discount. Oh, then by all means, please do that. But other than that, I always like come up with a payment plan, a structure. But at the same time, do not neglect your investment in particular. So I think the question was saving. So I won't say saving, instead invest. So you can pay your debt as long as it's consolidated, and invest your income simultaneously. Like, they can work hand in hand. You just have to find your strategy and find what works for you and find the balance. um so that's that. Okay, there are so many questions about extra income and passive income. Should I rent or buy a house? I think I'm the wrongest person to ask this question. Why I say so? Because several times I've literally been on the verge of buying a property. Like, all I had to do was just sign off, and then I changed my mind. Well, that was back home in my country, Nigeria. Like, I literally, one time, like, I was just all the level of just transferred the money to them. Like, I just need to transfer the money, sign the document, and I'm like, and then I just pulled out last minute. And I always say that because for me, that property as at then was gonna cost me 100 million naira, which is currently about, let's say, between 50,000 pounds thereabout, So 40K pounds, I think so. I'm not sure the exact figure. So I now thought about it in my head as calculation, as I invested that I am. I'm like, this 100 million now. If I invest it in, let's say, treasury bills or in mutual funds or euro bonds at a 10% interest, because back home we have interest rates in double digits, not like the UK where it's 3%, 4%. Like, I was gonna be getting like about between 15 to 20 million, depending on the interest rate. If it was between 10 to 20%, current interest is as high as 28%, like 20 million that investment. Now, with that 20 million naira, the house I wanted to buy, I'll be able to rent it comfortably. I still have a lot of change, a lot of money to do other things like travel, have fun, and I pulled out. This happened to me twice. It's very funny because the last property I wanted to buy, I recently like called them again, and it's quadrupled in price, even though it makes no sense because there was really no amazing development that went on there. But basically, it's quadrupled in price. And now I'm crying and now I'm looking for a payment plan, how to buy the property. So I would say it depends on you. Back then, real estate was really not on my radar. And I do not regret it per se because now I'm going fully for investment purposes, not for residential. But back then I wanted to buy for residential purposes, but now I'm buying for commercial purposes. So now it's a lot easier. So but I always like to give this example. Real estate is not liquid, no matter what anybody say. The money you think you're going to make from real estate only becomes, like I said, when it is in your bank account. It's unless you see someone willing to pay you that equity that you've gained from real estate and the money is in your account. That's the only time you say, okay, you've made XYZ profit. But usually you have to give yourself a lot of time to be able to dispose of a real estate property, right? So which is why I said commercial is the best, because then you can turn it into so many things. It could be a warehouse, it could be, you buy what do you call it? A set of flats or an Airbnb or a short-let apartment or whatever it is. But this is where the stock market also comes in for us. You can invest in real estate on the stock market through REITs, real estate investment trusts. And it's amazing because REITs are mandated by law to pay out 90% of their profits to you as an investor. So let's say, for example, a REIT earns £1 billion this year. They are mandated to pay out 90 million, be 900 million pounds to you as an investor, basically, for investing with them. So why this is good is because there's usually a fixed interest rate, but your earnings per share can change. So for example, let's say you invest in realty income like me. I love realty income. They are dividend kings, never defaulted, good source of passive income on the stock market for those looking for passive income. So I invest in real estate income. It pays me 4 or 5% every year. And this year, they could make a lot of money and they could say, okay, we're going to pay you £10 per share. And next year, they could make little money and they're going to pay me £7 per share. It's still all within the 6% yield, but your earnings per share can change based off of the profit because they are mandated to pay out 90% of their profits to you as a shareholder. So I also like to give this example. Like, for example, if you want to buy property in the UK, you need like 20K to 50K deposits to buy that property. And then that's aside lawyer fees, house maintenance, looking for agents to let out your house, that is commercial, or if you're living in it. And then you have to pay mortgage every month. But if you buy a REIT on the stock market with that same 20K or 50K, you are guaranteed of at least 500 to £1,000 in passive income every month. That's for the REITs that pay monthly. But for realty income, I'm sure you'll get that every month. EPR properties currently at 7%. Is higher than realty income. You'll get that every month as well. Simon Property Group is currently at, I think, 6% or so. So you get that every month. For stocks like not VHYL, sorry, Primary Health Properties, that I think is about 11% yield or 10%. I'm not sure, but I know it's really quite high. You get that every quarter because they do not pay every month. So basically, this is something you get every single month for the rest of your life as long as you own that stock. No hassle, no maintenance, nothing, And this is aside capital gain, which is another way that you earn money from the stock market. So, I mean, guys, you can consider REITs as opposed to properties. So I'm not saying that I'm favoring one over the other. I'm just saying like there are other ways you can invest, especially if you don't have the initial capital, and you're looking for a good source of passive income. Okay, so these are like questions I got earlier. I don't know if the people that ask questions are here, but if you have any question, please drop it in the comment section. So this is supposed to be like just a Q&A about investing. If you have any question you want to start, any strategy, just let me know. I think that's basically all the questions. So I hope that basically this high paying. Okay, so Mesoma, if there are other high paying individual stocks or ETFs, so basically the stock market is categorized into two. So we have it's two, but me I categorize it into five, right? But it is two, right? So two is growth stocks number one, dividend stocks number two. So growth stocks are the stocks like Tesla, Apple, PLTR, that's Palantir, Amazon, Meta, Google. So these stocks, their primary focus is to grow the business. So they are reinvesting their money into their business, basically. So these are the stocks that can take your money from 100 to 1K, 100 to 10K, 100 to 5K real quick. But their dividend payment is low. Not all of them pay dividends, but the one that do pay very little dividends. While the dividend stocks, also varies, because now dividend stocks, I always say this, consumer staple goods, for example, are dividend paying stocks. So what are consumer staple goods? The things we use every day in our home. So look around you. What is that thing that if you go to your friend's house, you go to your neighbor's house, you see the same thing, like toilet roll, tissue paper, toothpaste, bottled water, groundnut oil, rice, stock cubes, things like that. So those are dividend paying stocks. So their main concern is to, pay out profits to their shareholders. So they really do not like reinvest all their profits to the business. So now, yeah, you can get between 3% to 5% to 6% for consumer staple goods. Then we have ETFs. So ETFs, basically, there are various types of ETFs and index funds. So we have the ones that track, like everybody knows S&P 500. That's the most popular one. Then we have like VHYL that tracks high paying, dividend stocks in the world. So the dividend yield is a little bit high for an ETF. While not every ETF pays like high dividends. So it depends on the exposure to the market or the industry. Some of the highest paying individual stocks I know of are REITs, which is why I say I categorize mine into like 5 places, are REITs. So which is because REITs are mandated to pay out 90% of their profits, to the government, and we know real estate. So most REITs are, like, how do we put it, they have high paying customers. They have customers that their pockets is very deep. And I always say, like, we interact with REITs every day. The shopping mall you go to, they're owned by real estate companies. The hotels you go to, they're owned by real estate companies. Even the stores you shop, Tesco, Sainsbury, like all those high end stores, they are owned by real estate companies. For example, Realty Income is like the landlords to Walmart, Amazon. So think of Amazon warehouses, it's being let to them by Realty Income. So this is a company that basically has high end clients in their portfolio, and they're mandated to pay out 90% of their profits. So of course you should expect that they have high yield. So if you're really looking for high dividend paying individual stock, then you want to look out for REITs, Realty. I can tell you like some, like the Realty Income, EPR Properties, Primary Health Properties, Supermarket Group, Apple REIT, Apple Hospitality, that's the name, not Apple REIT. So I can give you a list, but then, because they are paying high dividend does not mean that you just go and buy only REITs. No, that would mean that you're too, concentrated in one sector. You have to diversify, across industries. It's always very important for you to diversify. No matter how good an investment return is, you don't want it to be too correlated. Like, it has to mirror and show like various industries, if that makes any sense. So any more questions? I'll just take a few more questions before we call it a night or a day or wherever you are. Okay, so it was nice having this session, and actually something I need to do often. I just need to have the questions, rolling and all. But I just want to say this: like, investment is hard but easy. I think once you start, you get a hang of it. I always say it's like driving your car. You need practical. You need to practice consistently for it to get a hang of it. You need to actually implement. And I think the problem most people have is implementation. Because acquiring all the knowledge is one thing, just one part of it. Actually implementing what you've learned is the most important part. So, okay, guys, thank you for joining. Thank you for tuning in. You can probably watch this later because it's going to be saved and it's going to like appear on the, what do you call it, on either the shorts part or the main videos part. I don't know, but yeah. So it was nice having this session with you. Thank you for tuning in and have a good evening. Bye.